You know, when you tap your credit card or maybe click buy online,
Hmm.
ever really stop and think what's like actually going on behind that simple click?
It's pretty complex, right?
Yeah. So today we're kind of pulling back the curtain on credit cards. We want to figure out how they really work and maybe more interestingly, how the companies behind them make their money.
Exactly. Think of it as getting straight to the point. We've looked at a lot of info to, boil it
I'm
down.
talking the nuts and bolts, right?
Right.
Cutting through the jargon.
That's the plan. We'll break down how cards function day to day and, crucially, where the revenue comes from. Goal is simple: clarity for everyone listening.
Okay, let's jump in then. What's the absolute first thing we need to get about credit cards, like the foundation?
Right. The most critical difference, really, is between credit and debit. A credit card means you're borrowing money for that purchase.
Okay, so it's not my money from my bank account.
Exactly. A debit card pulls directly from funds you already have. Credit card use means you're tapping into a line of credit, a loan, essentially, from whoever issued the card. Could be a bank, credit union, whatever.
Gotcha. And what about the big logos we see? You know, Visa, Mastercard, Amex, Discover. Where do they fit?
Ah, good question. They're the major networks. Think of them as the traffic controllers and rule makers for card payments. They run the tech networks that let the transaction happen between the store's bank and your bank.
So they connect everything.
Pretty much. They set standards, manage the communication, and of course, their brand name is what makes the card widely accepted.
Makes sense why businesses would want to take them then. Feels like almost everyone uses plastic these days.
Oh, absolutely. They're huge. And another point, credit cards often have, well, arguably better security protections than debit cards sometimes. That's another plus for the user.
Okay, so each swipe is like a mini loan. Now, the big question,
Mm-hmm.
how are these companies actually making money? It's not just out of the goodness of their hearts, right?
Huh, definitely not. The number one way is interest charges. You'll see this called the APR, or annual percentage rate.
Right, the APR.
Yeah. That's the interest they charge on any balance you don't pay off completely by the due date each month.
So hypothetically, if I'm really good and pay my bill in full every single month, I can kind of dodge those interest charges.
You absolutely can. That's the key. But the moment you carry a balance over from one month into the next, that APR starts to bite.
And those rates aren't the same for everyone, are they?
No, not at all. They often depend heavily on your credit score, your creditworthiness. Generally, a better score gets you a lower APR.
Can you give us a sense of like how much that actually adds up in real terms?
Sure. Let's say you've got $1,000 balance hanging around on a card, and the ATR is, say, 20%.
Hmm.
Well, you can roughly figure out the daily interest, take that 20%, divide by 365 days, apply it to the 1,000 bucks. You're looking at maybe 55 cents a day in interest.
Doesn't sound like that much per day, but I guess it adds up.
It really does, especially because it compounds.
Yeah.
And think bigger picture. In 2022, the major credit card companies collectively brought in over $105 billion just from interest.
Wow. Okay, 105 billion? That's staggering.
Yeah.
And I think I heard somewhere that the gap between the interest they charge us and the basic interest rates is growing too.
That's a sharp observation. Yes, the average APR margin, which is that difference between the average rate charged and the prime rate, kind of baseline, it's actually hit an all-time high.
So borrowing on a credit card is getting relatively more expensive for us.
Effectively, yes. It signals that profitability on the lending side for issuers is increasing. It's definitely a significant trend.
Okay, so interest is massive.
Yeah.
Huge driver.
Yeah.
What else? Where else are they making money? Because I know I've definitely been stung by a late fee before.
Oh, yeah. Fees are the other big part of the income pie. Late fees are a classic example charged if you miss that payment due date. Interestingly, there's been a recent move by the CFPB, the Consumer Financial Protection Bureau. They finalized a rule aiming to cut down on what they called excessive late fees, especially for the really big card issuers.
Oh, really? What kind of change?
They're trying to lower the typical fee from around, say, $32 down to $8 for those large companies. But even with that potential change coming, late fees still accounted for something like $14 billion in revenue back in 2022. So, still a good reason to pay on time.
Ouch. Yeah, lesson learned.
Yeah.
Any other common fees we should watch out for?
Definitely. Some cards, especially the ones pushing great rewards or perks, have annual fees. You just pay that every year to keep the card active.
Okay, like for premium travel cards sometimes.
Exactly. And then you might see fees for doing a balance transfer, moving debt from one card to another, or fees for getting a cash advance, like using your credit card at an ATM. Those tend to be quite high, actually.
Right. And it's not just us, the cardholders, paying fees, is it? The businesses, the stores, they pay something too.
Oh, absolutely. Merchants pay what are called processing fees to be able to accept credit cards. It's a bundle of different costs, really.
Okay, what's in that bundle?
The biggest piece is usually the interchange fee. Think of it as a fee paid between the banks for each transaction. When you buy something, the merchant's bank, the acquirer, pays this interchange fee to your bank, the issuer.
Huh. So it's like a cost the store has to bear just to let me use my card?
Precisely. And the card networks, your Visa or Mastercard, they actually set these interchange rates.
Oh.
And these rates aren't fixed. They can change based on like the type of card used, whether it's a fancy rewards card or a basic one. If the purchase is online or in person, even the merchant's industry can affect the fee.
Wow, that's complicated.
It can be. On top of interchange, merchants also pay smaller assessment fees directly to those card networks based on their total sales volume. And then the company that actually handles the transaction for the merchant, the payment processor, adds their own markup.
These payment processors,
Mm-hmm.
do they all charge businesses the same way?
No, there are different models. Some offer a simple flat rate like 1% plus a small fixed fee per swipe. Others use Interchange Plus, where the merchant pays the actual interchange cost plus a set markup from the processor.
Any others?
Yeah, some even do subscription models now, maybe a monthly fee, but potentially lower costs per transaction. Depends on the business's volume and needs.
Interesting. So I guess businesses have to build these costs into their prices somehow. Can they do anything to lower these fees?
They can try. Businesses doing a lot of volume might be able to negotiate better rates directly with their processor. Choosing the right type of pricing model for their specific business helps too. And keeping chargebacks low, those are disputed sales. That's important, as high chargebacks can lead to higher fees.
Okay, wow. So we've got us, the cardholders,
Mm-hmm.
the stores, the networks like Visa, the banks issuing the cards, the banks handling the store side. It really is a whole interconnected system.
It absolutely is. Let's maybe tick off the key players in this ecosystem, right?
Good idea.
So first, there's you, the cardholder. You get convenience, maybe rewards, that deferred payment, security benefits. But you might pay interest and fees.
Right. Then the merchants, the shops, they get potentially more customers because they accept cards, but they have to pay those processing fees we just talked about.
Correct. Then you have the issuers. These are the banks or credit unions actually giving you the credit line. They earn the interest, they earn many of the fees, and crucially, they take on the risk that you might not pay them back.
And historically, that's been pretty profitable for them.
Very. Credit card divisions have often been more profitable than other parts of banking. Then there are the acquirers.
Those are the merchant banks, the payment processors?
Exactly. They handle the transaction processing for the merchant, connecting them into the network and to the issuers.
Okay. And the last piece.
The card networks themselves, Visa, Mastercard, Discover, Amex, their job is mainly to facilitate everything, set the operating rules, manage the communication flow between the issuers and acquirers, and they earn those assessment fees we mentioned based on the volume flowing through their systems. Their business is enabling all these transactions.
Got it. Now, what about all the rewards? The cash back, the points for travel? It seems like every card offers something. How do they fit into the money-making side?
Rewards are, well, they're a really big deal. They're a primary tool for card companies to attract you, get you to sign up, and also to encourage you to use their card instead of another one or cash.
Makes sense. More spending, more potential revenue for them?
Right. But it's a double-edged sword for the issuers because the cost of providing these rewards programs has actually been going up. That eats into their profit margin, the net amount they make on each transaction.
So it's not exactly free money for us then, is it? Someone's paying for those points.
Not really free, no. Ultimately, the cost gets absorbed somewhere in the system. It's often factored into the interchange fees merchants pay, which can indirectly influence prices, or it's covered by the interest and fees paid by cardholders who carry balances. And it's kind of fascinating. Studies show that a lot of people who are actually in credit card debt still focus hard on maximizing rewards.
Really? But wouldn't the interest they're paying wipe out the value of the rewards?
Almost certainly, in most cases. If you're carrying debt, paying that down should almost always be the priority over chasing points because the interest is likely costing you far more than the rewards are worth. But, these programs are designed to be attractive. Tap into that desire for a freebie.
That's a really critical point. Okay, looking forward then.
Yeah.
What's the future hold for credit cards? Are they sticking around? Is something else going to take over?
Well, the consensus seems to be that credit cards aren't going anywhere anytime soon. In fact, we're still seeing overall credit card usage increase. What is changing is how we use them. Think mobile payments, contactless tapping. It's all about convenience. Security is also a huge focus. Things like tokenization are becoming standard.
Tokenization, what's that?
It's where, for online shopping especially, your real card number isn't transmitted. Instead, a unique digital token is used for that specific transaction. It makes it much more secure. We're also seeing more biometric authentication, fingerprints, Face ID, that sort of thing.
Yeah, I use my phone to pay way more often now. What about digital wallets? Or those QR codes you sometimes see?
Yep, those are definitely gaining traction too. More convenient ways to pay. The whole industry is also focused on making online checkouts smoother, faster. And behind the scenes, AI, artificial intelligence, is playing a bigger and bigger role in detecting and preventing fraud.
So things are changing, but the basic idea of the credit card is still strong.
Seems that way. The payment landscape is definitely evolving. Maybe we see more buy now, pay later options fitting in too, but credit cards look set to remain a really central part of how we buy things.
Okay, this has been super helpful. To wrap it all up, what are the absolute key things listeners should take away from this deep dive?
I'd say the main points are credit card companies make most of their money from interest charged on balances people carry over, and from various fees. Interchange fees paid by merchants are a big one, along with late fees and sometimes annual fees.
And it's a whole network, right? Everyone plays a part.
Exactly. It's a system with multiple players, you, the stores, the banks on both sides, the networks connecting them. Each part provides some value and incurs some cost.
So really, understanding this whole business model isn't just like trivia. It can actually help us use our cards better.
Absolutely. Knowing how it works helps you make smarter choices. Maybe you'll choose a card with features that suit you better, or you'll be more motivated to pay that balance off to avoid interest, or more aware of potential fees. It empowers you.
That's a great way to put it. This has been incredibly enlightening. So for everyone listening, now that you have this clearer picture of how the credit card business actually functions, maybe ask yourself what parts of your own credit card use might you reevaluate. Definitely something to think about.
And don't forget, there are great resources out there like the CFPB website or other financial education sites if you want to dig even deeper.
Perfect. Thanks so much for breaking that all down for us.
Yeah.
And thanks to all of you for tuning in to this deep dive.